Welcome back to the Deep Dive. It is Tuesday, January 27th, 2026.
Be there.
Today, we are turning our attention to a company that's often, invisible to the average person, but is basically the circulatory system of the food world.
That's a good way to put it.
We're unpacking Sysco, ticker SYY, and their Q2 fiscal 2026 earnings report, which just landed this morning.
Yeah, and this one is fascinating to look at right now. I mean, when people hear food distribution, their eyes kind of glaze over.
Right. Just boxes on a truck. Sounds a bit dry.
It does. But Sysco is such a massive barometer for the economy. If people stop eating out, Sysco usually feels it first. But what we saw here is, well, it's a really interesting paradox.
A paradox. Okay, you have my attention. I mean, usually these big industrial companies are pretty straightforward. Economy goes up, they go up. What's the conflict?
Well, just think about the restaurant industry right now. It's tough out there. The data they referenced on the call, specifically black box intelligence data, it shows that traffic to restaurants declined more than 200 basis points year over year. So that's a drop of more than 2% in foot traffic.
Right, and that tracks. Inflation's still around,
Right.
Menu prices are high, so yeah, fewer people are going out to eat. That makes sense.
Exactly. And it got worse throughout the quarter, from October through December. So, basic logic would say, if restaurants are serving fewer people, they should be ordering less food.
Sysco's volume should be down.
It should be. If the dining rooms are emptier, the Sysco trucks should be lighter. But that's the paradox.
Okay.
Sysco's U.S. food service local volume, it didn't go down. It went up. It was up 1.2%.
Wait, so the whole pie is getting smaller, but their slice of it's getting bigger.
Significantly bigger. And it's speeding up. That 1.2% growth is a 140 basis point improvement over what they did just last quarter.
Wow.
So our mission today is to really unpack how a giant like this generates what they're calling self-help growth in a pretty sluggish economy.
Self-help growth. I like that. It sounds like they're not just, waiting around for the economy to magically get better for them.
Precisely. They are pulling their own levers. We're going to look at how they're using AI, some really strategic shifts in their product lineup to deal with inflation, and a booming international business is just defying the odds.
Okay, let's start with that volume growth, because that's the headline number. Up 1.2% while the industry is down. How are they doing that? Is it just like aggressive discounting?
You'd think so, but it's actually more sustainable. It all comes down to a classic market share story. It's about something they call the spread.
The spread.
Yeah, the gap between winning new customers and losing the ones you already have. The CEO, Kevin Hurricane, was really clear about this on the call.
Okay.
They're winning new business at a high rate, sure, but the key thing is they're losing fewer existing customers. Their retention is getting better.
So they've plugged the leaky bucket.
Exactly. I mean, in distribution, you always have churn. Restaurants close, they switch suppliers, a new chef comes in. But when you can plug those leaks and keep pouring new customers in the top, the water level rises.
Even if the economic rain isn't falling.
That's the idea.
But how? I mean, how are they plugging the leaks? Is it just better service? Because that feels like a cliche.
It is, but they actually have the data to back it up. It's a mix of people and technology. This is where we get into their secret sauce. First, the people.
Right.
They mentioned that their sales consultant, or SC retention rates, are at or above historical highs.
Why does that matter so much? I mean, can't you just hire a new sales rep if one leaves?
In food service, that's a really dangerous assumption. Relationships are everything. An experienced rep, they know the chef, they know the menu, they know that restaurant needs extra mozzarella on Fridays.
That's a great point. If I'm a restaurant owner, I don't want to have to train a new 22-year-old rep on my business every 6 months.
Exactly. So that stability breeds loyalty. And because their retention is so high, the new people they hired a while back are moving up the productivity curve. They're getting better.
So they're getting smarter and faster.
Yes, but they're not just relying on experience. They've given these reps what is basically a superpower. It's a tool called AI 360.
Ah, of course. The AI mention. Can't have an earnings call in 2026 without mentioning AI. Is this real, or is it just buzzword bingo?
I'm usually skeptical too, but this looks like the real deal, and it's because of the adoption rates. It's a CRM tool that's been live for about 4 months, and here's the stat that blew me away.
Okay.
They have a 95% weekly usage rate among their sales reps.
95%. That is wildly high for any kind of enterprise software. You usually have to force sales reps to use the CRM.
You do. If it was just for tracking them, they'd hate it. But the data shows a direct link. Reps who use the tool more sell more. It's giving them actionable plays. And the best one they highlighted is this feature called Swap and Save.
Swap and save? Okay, it sounds like a game show, but I'm guessing it's more practical.
It's a game changer for right now. Think about that restaurant owner who is struggling. They're desperate to cut food costs. They're looking at their invoices and, panicking.
Right, labor's up, inflation's hitting them. Every penny counts.
So Swap and Save is a suggestion engine for the sales rep. The AI looks at the restaurant's buying history, their cuisine type, everything. It doesn't just say, buy cheaper chicken.
It's more specific.
Way more specific. It says, hey, this Italian place buys national brand chicken breast A. Based on their menu, our Sysco brand chicken breast B is a perfect substitute, and it'll save them 50 cents a pound.
So the rep walks in with the solution to the customer's biggest problem already loaded up. No searching through a catalog.
With one click, the CEO called it a win-win-win.
Okay, let's walk through those wins. Because usually if the customer pays less, the company makes less.
Not always. So, win one, the customer saves money.
Mm-hmm.
That builds massive goodwill and helps them survive. Win two, Sysco makes the sale. They switch the customer to their own private label product.
And private label stuff almost always has a better margin for the distributor, right?
Bingo. So even if the revenue per case is a little lower, the profit dollars might be the same or even better. And win three, the rep makes more commission because they closed the deal.
That's really clever. It aligns everyone's incentives. The rep isn't just trying to upsell. They're acting like a consultant trying to help the restaurant.
And that builds stickiness. If you help me save $500 a week on my food costs, I'm not leaving you for a competitor over a free case of tomatoes.
Right. They also briefly mentioned their loyalty program, Perks 2.0. What's that about?
That's about share of wallet. A restaurant might buy 40% of their stuff from Sysco and the rest from other places. Perks 2.0 is designed to get that 40% up to 60 or 70 by rewarding them for consolidating their orders.
Got it. So that's the tech and people side. But let's go back to the product itself. You mentioned switching brands. Is Sysco actually changing what they sell?
They are. They're shifting strategy to meet the moment. I mean, historically, Sysco is known for dominating the premium or better best tier of products.
The fancy stuff, the high-margin ingredients.
Exactly. But in a high-inflation world, restaurants need options. If Sysco only offers the premium steak, what does the restaurant owner do when they need to cut costs?
They go somewhere else. They go to the cash and carry or another supplier to find the generic stuff.
And that's the leakage we talked about. So Sysco is actively filling the voids in their value tier. Their brand for that is Sysco Reliance.
So is this just lower quality food? That seems like a risk to their brand.
They were careful about that. It's not bad food. It's the good option in a good, better, best lineup. Think of it like a store brand pasta versus the fancy imported Italian kind. It's still good pasta, just cheaper.
So if a customer needs to trade down to save money, they can trade down within the Sysco family instead of leaving it entirely.
It's a purely defensive play. You're building a fence around your customer. And they said this whole project, filling out that value tier, is going to continue all through calendar year 2026.
It sounds smart, but isn't there a risk of cannibalization? Someone buying the expensive steak might just switch to the cheaper one.
That's the risk, for sure. But their calculation is that it's better to keep the customer on a cheaper steak than to lose them completely. Plus, they're pairing this with what they call pricing architecture.
That sounds very corporate. What does it mean?
It means they're using AI to make sure their Sysco brand prices move in lockstep with the national brands. If the name brand price drops, their brand price adjusts instantly to maintain that value gap. It's about being nimble 24/7.
It's like they're trying to act like a startup for a company that big.
They're trying to shift from just being a logistics company, a box mover, to being a data company that happens to move food.
Okay, before we hit the financials, I saw a note on international. We usually focus on the U.S., but it looks like the international business is putting up some huge numbers.
Crushing it is probably the right term. While the U.S. is fighting for that 1.2% growth, international is flying. Sales were up 7.3%. Local case growth was up 4.5%.
That's a massive difference from the U.S. Why? Is the economy just that much better in Europe or Canada?
Not really. I mean, the UK and Canadian economies have their own issues. It's more that they're just successfully exporting the US playbook.
And what's the playbook?
It's everything we just talked about. Improving their supply chain,
Hmm.
pushing their own Cisco brand products, which have better margins, and rolling out these same tech tools around the world. They're taking what worked here and deploying it in markets where they just have more room to grow.
So they're optimizing markets that were maybe a little undermanaged before.
Exactly. And look at the profit. Adjusted operating income for international was up almost 26%.
Wow.
That is the ninth straight quarter of double-digit income growth for that segment. It's becoming a real profit engine for them.
And there was a note about Mexico
Right.
for the model watchers.
Yes. They have finally fully lapped the exit of their Mexico business, so the comparisons going forward are going to be much cleaner. No more asterisks on that growth.
Got it. We also saw some M&A news with Ginsberg's Foods.
Yeah, this is a classic tuck-in acquisition. Ginsberg's is a family-owned distributor in the Northeast Hudson Valley area, a very high-density, high-value region.
We hear tuck in all the time. Why is buying a smaller player better than just trying to win their customers?
It all comes down to density. That's the magic word in distribution. Think about it. A Sysco truck costs the same in gas and driver pay to drive down a street, whether it stops at 2 restaurants or 7.
The fixed costs are high, right?
So if you can make 5 stops on one street instead of 2, your profit on that route just skyrockets. By buying Ginsberg, Sysco instantly gets that density. They don't have to fight for each account. They just buy the whole route.
And then they can use their massive purchasing power to lower the costs for those new customers.
Exactly. They get to leverage their scale. It's a model that's worked for them for years.
Okay, so let's get to the bottom line. All this stuff, the AI, the value products, international, what did it all add up to?
A solid beat. Adjusted EPS came in at 99 cents, which beat the consensus by a penny. Total sales were around $21 billion, up 3%.
And what about margins? With inflation, you'd expect those to be under pressure.
They actually expanded. Gross margins were up 15 basis points to 18.3%, and that's largely due to strategic sourcing,
Which is corporate speak for.
using their huge size to get better prices from their suppliers. I mean, when you're the biggest buyer, you get the best deal.
And the future. What do they tell us to expect for the rest of 2026?
They were surprisingly bullish, honestly, given the weak economy. Management raised their full-year guidance for adjusted EPS to the high end of their 40.50 to 40.60 range.
Raising guidance in this environment is a bold move. Usually companies are trying to lower the bar.
It just shows how confident they are in these self-help initiatives. And the CEO, Kevin Herkin, he actually made a specific promise. He committed to at least 2.5% local volume growth in both Q3 and Q4.
At least. Wow, he's putting a floor on it. That's risky.
It is. He even broke it down for them. He said about 2.1% of that will be organic growth from just selling better, and the other 0.5% will come from that Ginsberg's acquisition.
So they have a clear path to that number. Did they say how January was looking?
They said January started strong, continuing the momentum, but, they added the classic disclaimer about winter weather being a variable.
Right, snowstorms stopped the trucks.
And they stop people from going out to eat, so there's always that short-term noise.
And capital allocation. Cisco is a dividend aristocrat. Still paying out.
Oh, yeah. The plan is for about $1 billion in dividends and another $1 billion in share repurchases. And the buybacks are starting up again in Q3.
So they're buying their own stock, putting their money where their mouth is.
Precisely. It's a signal they think the stock is undervalued.
Before we wrap, we should mention a big leadership change. Sometimes this kind of thing can spook investors.
Yes. Greg Bertrand, the COO, is retiring. He's a 35-year veteran of the company.
35 years, that is a lifetime. That is a huge amount of institutional knowledge walking out the door.
It is. He's seen it all.
Yeah.
But they announced a clear transition plan, so the market didn't seem to panic. It is something to watch, though. You don't want to lose focus on just running the business day to day while you're chasing all these big new ideas.
Absolutely. A lot of moving parts to manage without your veteran COO.
For now, the ship seems steady.
Okay, let's wrap this with a so what. We have a company growing when its customers aren't. They're using AI to get smarter, pivoting to value products to keep customers close.
Yeah, the big takeaway for me is that Cisco is proving it can kind of decouple its own performance from the broader economy. They're not just riding the wave, they're building a better boat.
They're changing from a box mover to a data-driven partner.
And that kind of partner is a lot harder to fire than just a regular vendor.
Okay, do you have a final provocative thought for us? Something to chew on?
I do. We spent all this time talking about swap and save and AI tools for the sales team, the human side.
Right. The human connection.
But during the Q&A, management dropped a little hint about future warehouse automation. We're talking robotics in the freezer.
Oh, interesting. So not just AI on our iPad, but actual robots moving the boxes.
Right. Right now, Cisco's advantage is its people and its density. But if the sales side is being optimized by AI and the physical supply chain starts to get fully automated, I mean, imagine a world where the rep is AI-assisted and the warehouse is run by robots.
That sounds incredibly efficient, but also incredibly expensive to build.
Very expensive to build. But once it's built, it creates a competitive moat that no smaller player could ever cross. I mean, a local guy can buy a truck. He can't buy a fully automated, AI-driven supply chain.
That's a great point.
The question is, how fast can a giant like Cisco actually automate its physical warehouses? That's the race to watch over the next decade.
From swap and save to robots in the freezer, Cisco is definitely not sitting still. That's all for today's deep dive. Thanks for listening.
Take care.